Welcome to today's market report.
European shares chalked up their worst week in 2 months on Friday, with tech stocks and retailers feeling the brunt of selling on the prospect of bigger interest rate hikes to tame decades-high inflation. Long-dated US Treasury yields surged and global stock markets slid further as investors worried the Federal Reserve may not be able to curb inflation in the years ahead, even as US data showed decelerating wage growth in April. Labor Department data showed the unemployment rate fell last month to its pre-pandemic low of 3.5% as job growth moderated. Average hourly earnings rose 5.5% from a year ago, slightly slower than the previous month's increase. The data underscored challenges the Fed and the other central banks face as they battle rising inflation, with China's lockdowns causing persistent supply chain disruptions and the war in Ukraine pressuring food prices. The inflation outlook past the next 2 years is beginning to look cloudier for bonds, at least for bond traders. The yield benchmark 10-year Treasury notes rose to 3.121%, a rate last seen in November 2018 after sharply rising from about 1.5% at the end of 2021. The Fed hopes to slow inflation by tightening monetary policy. Market volatility has increased on fears too much tightening could cause a recession. Trade was volatile on Wall Street. The major indices rose briefly into the green, and the Nasdaq fell as much as 2.66%. The Nasdaq and S&P posted their fifth straight week of declines. It was the longest losing streak for the S&P 500 since mid-2011 and for the Nasdaq since late 2012. The market is focused on the Fed being behind the curve, and is why the market is down. Fed funds futures priced in a roughly 75% chance of a 75 basis point interest rate hike at the next month's Fed policy meeting. GBP/USD is trading at 123.52, down 1.74% for the week. Euro/dollar trimmed some earlier losses, trading at 105.52.
This is today's market news. Thanks for listening. We'll see you next time.